You may not know this, but the Jackson Hole Central Bankers Symposium has traditionally been the most serene academic salon for central bank governors. In previous years, everyone would sip coffee by the floor-to-ceiling windows, chat about interest rate models, and casually changing the direction of global markets. But this year, everything was different. The atmosphere on site was tense, security noticeably heightened, far beyond previous years. As attendees entered the venue, they were greeted by a visible police presence, officers patrolling hotel entrances, and even temporary barriers set up in case of any unforeseen incidents. In that moment, many in the room realized that this year's symposium was no longer a simple academic discussion of central banks, but was now overshadowed by a strong political undercurrent. It all began early on Friday morning, when an otherwise peaceful hotel lobby erupted into an argument. A man named James Fishback, a longtime critic of the Federal Reserve and a supporter of Trump, approached Lisa Cook, loudly questioning her about the mortgage controversy. The situation quickly escalated, and the police had to intervene and escort him off the premises. The Jackson Hole Symposium has always been one of the most prestigious events in the central banking world, typically known for academic debates and never for conflicts. Yet this year, the drama unfolded right at the entrance of the venue, an event that exposed the Federal Reserve's once unassailable image. The Fed was being pulled down from its pedestal and turning into a political target. And at the root of all this is Trump, who has completely torn away the veil of modesty, shifting his criticism from Powell to the entire Federal Reserve. He's not just slamming the chairperson on Twitter. He's made his intentions clear with a three-step plan to seize control of the Fed. Step 1. Replace Powell. Step 2 will take control of the board. Step 3. Purge the regional Federal Reserve chairs. Since its founding in 1913, the Federal Reserve has maintained its independence through a dual structure of the board and 12 regional reserve banks. Now, Trump wants to dismantle this century-old firewall. Imagine if he succeeds. The pricing anchors for the U.S. stock market will no longer be CPI and non-farm payrolls, but the political agenda of the White House. A tweet today suggesting a rate cut sends the markets soaring. A remark tomorrow about firing someone causes them to crash. This is no longer about central bank decisions. It's about the trust system that underpins the U.S. financial system being violently torn apart. Hello, dear investors and finance enthusiasts. Welcome back to my channel. I'm Ella. Today, we're going to dive into a topic that's shaking the financial world. Is the Federal Reserve being controlled? Trump is dismantling the Fed's century-long independence. Is the next Nixon moment upon us? You heard that right. Recently, Trump's actions against the Fed have had everyone on edge. From demanding Powell cut rates to his sharp attacks on Governor Cook, what's really behind this? Is the Federal Reserve, long regarded as an independent decision-maker, facing an unprecedented crisis? Stay with me for the next few minutes as we unravel the logic and impact of these events. It's been 2 days since the Jackson Hole speech, and on the surface, the market seemed to have come to terms with the high likelihood of a rate cut in September. But don't be fooled. The impact of this speech is far more than just whether or not rates will be cut. Over the past 2 days, Wall Street funds have been jumping between tech stocks, bonds, and gold, with prices fluctuating as if they're being pulled in different directions. Why is this happening? Because traders are starting to reprice a much bigger variable, the risk to the Federal Reserve's independence. And the one who's planted this bomb in the market is none other than Trump. He's not just exerting pressure through rhetoric. He's laid out a clear 3-step plan. Let's break these steps down. Trump's first step was to target Federal Reserve Chairperson Jerome Powell. Do you remember, in 2018, it was Trump who appointed Powell to the position. But just a few years later, he began attacking him at every turn. During the 2020 pandemic, Trump openly called Powell a big dumb guy. and even said in an interview that Powell is a bigger enemy than China, a comment that shocked the global financial markets at the time. On social media, he was even harsher, criticizing Powell for raising rates too aggressively, saying he nearly killed the U.S. economy, and then complaining that Powell wasn't cutting rates quickly enough, calling him too late. In Trump's eyes, no matter what Powell did, it was wrong. Now, Trump has taken it a step further, declaring that if he were to reshape the Federal Reserve, Powell must go and be replaced by someone who understands politics. According to the timeline, Powell's term doesn't end until next year. But Trump's three-step plan goes far beyond that. Step 2 is that he is systematically undermining the independence of the Federal Reserve's board. According to recent developments, Trump's camp has been pressuring Governor Lisa Cook over mortgage fraud allegations, while also pushing for his ally Stephen Miron to fill the recently vacated seat of Governor Kugler. If Cook is forced to step down, Trump will control 4 out of 7 seats on the board, giving him absolute power. What's more crucial is that the reappointment of the 12 regional Federal Reserve chairs requires board approval if Trump takes control of the board. When these regional chair terms expire in February, he could replace these key positions with his own people. Step 3 sees Trump using both legislative pressure and public opinion to shake the very foundations of the Federal Reserve. Not only is he demanding an investigation into the Fed's overspending on renovations to corner Powell, but he's also pushing for crypto legislation such as the Genius Act and others, attempting to bypass the traditional dollar settlement system with stable coins, undermining the Fed's current issuing power from the ground up. This pincer attack seeks to control the decision-making through a purge, while weakening the core functions of the Fed with technological alternatives. It's a direct strike at the Federal Reserve's century-old system. The essence of this power struggle is a clash between two financial governance models. On one hand, you have the Fed's independence, sustained by its dual structure of the board and the regional reserve banks. On the other, Trump's ambition to fully politicize monetary policy. As the market begins to price in the risk to Fed independence, the anchor for U.S. stock pricing is shifting from CPI and non-farm data to the political rhythms of the White House. This is no longer just Powell's personal crisis. It's a century-old challenge to the dollar's credit system. If Trump's three-step plan succeeds, we might witness an even more profound paradigm shift than the one in 2008. But don't forget, the U.S. president has the right to nominate a new chairperson ahead of time. If the White House and the Senate push hard enough, this step could very well become a reality. Step 2. Control of the Federal Reserve Board. The Fed's board consists of 7 seats. Trump has already appointed 2 members and is pushing for his economic advisor Stephen Miron to join the board, with the new chairperson to be nominated next spring and further upcoming vacancies. Trump will have the majority vote. What does that mean? It means that every major decision at the Fed, from interest rates to regulation, will be directly under Trump's control. Where we once looked at CPI and PPI, it may soon be more about what the White House needs. Step 3 is the most shocking, controlling the regional Federal Reserve chairs. The Fed has maintained a degree of independence because, in addition to the 7 Washington-based governors, there are 12 regional Federal Reserve chairs from cities like New York, Chicago, San Francisco, and Atlanta. These chairs are not presidential appointments. They are selected by local committees made up of bankers and business leaders, serving 5-year terms and providing a check against Washington's political power. But according to analysis by Nikki Maris from the Wall Street Journal, if Trump secures a majority on the board, he could refuse to reappoint these regional chairs when their terms end. The terms of all 12 chairs will expire by March next year, presenting Trump with an unprecedented opportunity. Once that hammer falls, the century-old firewall protecting the Fed's independence will come crashing down. The institutional red line that no one has dared to cross in over 100 years is now sitting on Trump's desk. Friends, What we're seeing today is actually something that has played out in history before. In the 1970s, U.S. President Nixon was a living example of this. At the time, the Federal Reserve chairperson was Arthur Burns, an old friend of Nixon's. What was supposed to be an independent central bank ended up being forced onto the election campaign trail. Nixon, desperate for re-election, strongly urged Burns to lower interest rates and pump liquidity into the economy to make the economic data look better before the election. In one closed-door meeting at the White House, Nixon even slammed his hands on the table and told Burns, "If you raise interest rates, you're going against me." Burns knew that raising rates was necessary, but under the pressure from the president, he chose to compromise. The result, the Federal Reserve lost its independence. In the short term, it seemed to work. Unemployment went down, the economy grew, and Nixon won re-election. But the cost soon became clear. After 1973, inflation in the U.S. spiraled out of control, with the CPI soaring to double digits. Ordinary people went to the supermarket and saw food and fuel prices rising almost every month. Add to that the Middle East oil crisis, and oil prices doubled. Wages and prices entered a vicious spiral. What happened next? The U.S. stock market went sideways throughout the 1970s, with no growth for 10 years. And even adjusted for inflation, it was a real loss. The bond market was battered by inflation, and long-term government bonds became untouchable. The only winners, gold and commodities. Gold skyrocketed from $35 an ounce to nearly $700 in just 10 years, an increase of nearly 20 times. So what markets fear the most isn't high interest rates or low interest rates, but the loss of the Federal Reserve's independence. Once a central bank no longer makes decisions based on data, but is instead hijacked by the political cycles of the White House, the foundation of trust in the entire financial system collapses. Today, Trump's three-step plan, replacing Powell, controlling the board, and purging regional Federal Reserve chairs, is leading us back to that dangerous crossroads. The problem is, this time, the market may not have 10 years to adjust. It could trigger a new wave of turmoil at any moment. Perhaps, friends, you've never really thought about what would happen if the Federal Reserve truly lost its independence. The first casualties wouldn't be the interest rates themselves, but the credibility of expectations. Financial markets fear not high rates, nor low rates, but the uncertainty of why rates are moving the way they are. This would have a massive impact on the market. The first wave of impact would be the rise in risk premiums. Over the past few years, why have companies like Apple, Microsoft, Nvidia, and Tesla been able to command sky-high price-to-earnings ratios? It's not just because they're stellar companies, but because investors believed the Federal Reserve was predictable. Raising rates when inflation rises, cutting rates when the economy slows, clearing rules. It's this certainty that allowed investors to use a very low discount rate when buying future cash flows over 20 years. But once the market feels that the Federal Reserve is no longer looking at the CPI or unemployment rates, but instead watching the political whims of the White House, everything changes. Investors will say, the future cash flows are more uncertain now, so I need a bigger discount. This is what's known as an increase in the risk premium. The discount rate, which might have been 5%, could now rise to 8% or even 10%. Don't underestimate the impact of just a few percentage points. The same future earnings with a 5% discount and an 8% discount can result in valuations dropping by a third or even half. So, the damage from political interference isn't that companies like Apple and Microsoft will suddenly stop making money, but that investors will no longer be willing to pay a premium for the future. The drop in stock prices isn't because earnings have collapsed. It's because trust has collapsed. The second wave of impact falls on long-duration assets. Companies like Snowflake, MongoDB, and CrowdStrike are different from tech giants like Apple and Microsoft. The tech giants at least have stable cash flows backing them, even if risk premiums rise and valuations shrink. It's merely a return from bubble levels to rational levels. But these long-duration growth stocks, which are almost entirely unprofitable, have their valuations built purely on investors' expectations of the next 20 years.
Stable discount rates sustain this dynamic and keep capital invested. But if the market sees Fed policies as politically driven with unpredictable rate moves, investors will first pull out. Without stable cash flow to fall back on, once expectations break, these stocks can quickly tumble from their inflated valuations. In other words, when the tech giants get hurt, it's a correction, but when story stocks get hurt, it's a crash. This is the second wave of impact, and it's even more severe than the first. The third wave of impact hits the banking system. Some might argue, a rate cut is good for banks, right? Loan costs go down, and financing demand increases. True, in the short term, there may be some stimulating effects, but the long-term risks lie elsewhere. Banks don't truly depend on high or low interest rates, they depend on the predictability of rates. Over the past few decades, no matter how large the economic fluctuations, banks have been able to profit by managing interest rate spreads and mismatching durations because they trusted that the Fed's actions followed a predictable pattern. But once the market starts to doubt that interest rate policy is being used as a political tool, that expectation is disrupted. The yield curve could flip at any moment today, forced to cut rates dramatically, tomorrow, forced to hike rates again due to inflation. For banks, the risk isn't an immediate blowout, but rather a sharp increase in the volatility of earnings. Large banks may still be able to buffer this volatility through scale and diversification, but regional and smaller banks are at greater risk because they are more sensitive to interest rate spreads and liquidity. Once the market loses trust in the Fed, equity indices are discounted, and financing costs rise, the banking system could become a frozen bottleneck. In other words, when the tech giants get hurt, it's a compression of valuation premiums. When story stocks get hurt, it's a collapse of confidence. And the risk for banks lies in the decreasing certainty of operations. The collapse may not be immediate, but it would lead to a bigger discount by the market.
Even more severe is the impact on trust in the dollar. For the past several decades, the reason the US dollar has held its position as the world's reserve currency hasn't been because of the soundness of US fiscal policy. In fact, the US deficit has been a regular occurrence. The real key is the credibility of the system, especially the Federal Reserve's independence. But if the market concludes that the Federal Reserve has become a political tool of the White House, even if interest rates don't fluctuate drastically, the dollar's anchor will fail. Foreign central banks and sovereign funds will begin to diversify away from dollar assets, putting more capital into gold, commodities, or even other currencies. For the United States, this is a fundamental upheaval. So, as you see, tech stocks will be hammered, not because of earnings issues, but because the premium support vanishes. Story stocks will be cleared out, not because the dreams are over, but because the discount rate is no longer trusted. Bank stocks will be hit, not because of high or low rates, but because of distorted risk pricing. The dollar will be questioned, not because of fiscal deficits, but because monetary policy is being hijacked by politics. The most profound impact is that de-dollarization could accelerate. The US dollar has reigned globally for decades, not because of America's fiscal health, but because the world trusted that the Federal Reserve was independent and monetary policy wouldn't be easily manipulated. But now that trust is being slowly eroded. Don't forget, the trend towards de-dollarization has already begun quietly. Over the last 2 years, BRICS nations have been advancing the use of their own currencies. Russia and India have been trading energy in rubles and rupees. Middle Eastern oil producers have increased settlements in Chinese yuan. Brazil and Indonesia have been reducing their reliance on the dollar. At first, these actions were slow, and the market still had an ingrained trust in the dollar. But if the Fed's independence crumbles, countries that were previously hesitant will rush to accelerate their moves. What does this mean? It means the faith dividend that the U.S. has relied on is fading. America has been able to borrow at very low costs because the world buys its bonds. U.S. tech stocks have enjoyed extremely high valuations because dollar-denominated assets have long been seen as a safe haven. Once this foundation starts to wobble, the high valuations of U.S. equities and the securities of U.S. Treasury bonds will both face simultaneous challenges. In other words, Trump's three-step plan may seem like a domestic political struggle, but for the global markets, it could be the final straw that breaks the dominance of the dollar. At this point, you're probably wondering, if the Federal Reserve really gets absorbed into politics, shaking the global capital order, what should ordinary investors like us do? Should we keep doubling down on tech stocks, no matter what? Or should we start adjusting our positions, looking for areas to hedge risks? Actually, history has already given us the answer. In the 1970s, Nixon pressured the Fed to flood the economy with liquidity, and the result was stagflation, a decade of stagnant stock markets and a devastated bond market. But some people survived, and even thrived. What was their secret? They shifted their focus to assets that didn't depend on the interest rate anchor. Why these assets? Because their value isn't tied to how the Fed sets rates, but to deeper, real-world demand and trust. The logic is simple. Once the trust in a currency erodes, people will turn to hard assets to preserve value. Resources like oil and copper, for example, are driven by global industrial demand. They won't simply vanish because the Fed changes course. Oil giants like ExxonMobil, Chevron, and other metal powerhouses often see their profitability increase during inflationary cycles. In other words, when the dollar loses its credibility and commodity prices rise, these companies stand to profit. Third, there are U.S. Treasury bonds and interest rate-sensitive assets. In the short term, U.S. Treasuries remain a safe haven. Why? Because if the market starts believing Trump will force interest rate cuts, long-term U.S. bonds TLT will strengthen, and the yield curve will shift, providing a buffer for investors. But unlike gold, the long-term risk for treasuries is de-dollarization. If global central banks stop buying, and the U.S. continues to expand its fiscal deficit, the long-term security of U.S. bonds will be questioned. Therefore, treasuries might offer a window of safety in the early stages of a crisis, but they can't be the final refuge. The fourth strategy, defensive consumers and healthcare stocks. When market confidence collapses, investors flock to assets with stable cash flows and high dividends. These companies sell products and services that people need regardless of the economic climate. They won't stop making profits just because the leadership of the Federal Reserve changes. What these companies offer to investors isn't a windfall, but the reassurance of survival. So the logic is clear. Tech stocks and growth stocks depend on reliable interest rates. Once those rates became politicized, their premiums disappeared. Gold and energy assets are underpinned by trust and real-world demand, neither of which will vanish because of political intervention. U.S. Treasuries can provide short-term safety, but their long-term outlook hinges on whether the world continues to trust the U.S. dollar. Defensive consumer stocks, however, are the final line of defense in protecting cash flows during periods of market turmoil. In short, don't just hold on to tech and growth stocks. Those are premium assets. Add assets that anchor trust, demand, and cash flow. These are the types of assets that can help ordinary investors weather the storm and survive. Given the current uncertainty, I've identified a group of sectors and companies that are either unaffected by changes in the Federal Reserve's independence or less impacted by such shifts. I've compiled a list of these, and if you send the code FED, you'll get access to it. Some of you might think that the impact of changes to the Fed's independence won't be immediately visible. But remember, market trends will eventually show us the answer. And what we can do now is prepare ourselves in advance. Don't forget to click the pinned link in the comments section to get the list. Now, some of you may be wondering, how can I determine whether the Fed is responding to economic data, or if it's simply yielding to political pressure from Trump? If it's the former, doesn't this mean the previous analysis is built on a flawed premise? Let's break it down with data. The overall CPI for July was 2.7%, and the core CPI was 3.1%. That's still quite far from the Fed's 2% target. Core PCE for June was 2.8%, with a month-on-month increase of 0.3%, which still isn't very reassuring. Looking at employment, July's non-farm payrolls added only 73,000 jobs, the lowest in nearly 4 years. Moreover, the May and June numbers were revised down by 260,000, and the unemployment rate ticked up to 4. But remember, 4.2% is still a relatively healthy level historically. It's far from signaling a recession. In other words, the labor market is cooling, but it's more of a deceleration than a sharp drop. Strictly by the numbers, a major rate cut isn't yet justified. At Jackson Hole, Powell acknowledged job market risks and the need for flexibility, but emphasized inflation isn't fully tamed. Markets prices in a 70 to 80% chance of a September cut. Yet the real deciders are upcoming data, August 29th PCE and September 5th non-farm payrolls. My conclusion is simple, purely on data. The Fed should likely wait. But here's the twist. Even before these key figures, Powell has proactively signaled dovishness, not with vague hints, but clear, strong signals. This reeks of political pressure. Maybe this is Powell's balancing act. If upcoming data aligns, he can frame a cut as data-driven. If not, he could still claim independence to resist pressure. The question, how long can he keep this up? But regardless of the underlying truth or the results in September, the most important thing for us is to prepare and act in advance. When it comes to investing, this is a strategy with no downsides. That's all for today's analysis on the intense battle between Trump and the Federal Reserve. From our discussion, it's clear that if Trump's interference with the Fed continues, it could have far-reaching consequences for the financial markets, both in the U.S. and globally. Once the independence of the Fed is compromised, the direction of monetary policy will become much more uncertain. As investors, we need to stay vigilant and closely monitor the developments that unfold. If you have any thoughts or questions about today's content, feel free to leave a comment below. And don't forget to like and share this video so more people can understand the shifting dynamics of the financial world. I'm Ella. Thank you for watching, and I'll see you in the next video.